Okay, let's unpack this. S&P 500 futures are part flat at 5,910, and the Nasdaq implied open is down just a marginal 0.1%.
Right.
It is Thursday, March 12th, 2026. We are in the pre-market, and the bell has not rung yet. If you are just glancing at the top-level numbers of the overnight session, it looks like the algorithms just fell asleep after a solid 3-day momentum run.
But the real risk here is trusting that surface-level calm. We are looking at a massive stack of overnight data today. We've got Tuesday's raw producer price index numbers, some fresh supply chain leaks out of Asia, and deep institutional flow data from the options market.
Yeah, none of this data points to a market taking a breather.
Exactly.
So our mission for today's deep dives is to look past this illusion, because if you look at the actual plumbing of the market right now, billions of dollars are violently changing hands in the dark.
It's crazy.
It is. It's like watching a high-rise building being demolished and completely rebuilt from the inside out while the exterior walls haven't moved an inch.
And the wrecking ball swinging inside that building is the inflation data we got on Tuesday. We have to look at the current roadblock. And right now, that roadblock is the inflation ghost. We all just kind of assumed the Federal Reserve had permanently busted.
Right, so let's break down that producer price index report. The headline number wasn't actually a shock to the street, was it?
No, not at all. Wholesale inflation rose 0.2%, which exactly matched the consensus estimates.
But the internal data tells a very different story. The core services component of that report is just stubbornly sticky. We are seeing a wage price spiral actively taking hold in the services sector.
Which instantly killed the market's assumption that a June rate cut was a slam dunk. We are now looking at a very firm floor under terminal rates.
So just to make sure we are contextualizing this correctly for you guys listening, if goods deflation is over, meaning the physical stuff we buy on shelves isn't getting cheaper anymore to offset other costs, but services are still getting more expensive, is this essentially like finally finding a cheaper car to buy, only to realize your mechanic just doubled his hourly rate to fix it?
Basically, yeah. But it's actually much worse than that mechanically. Because, I mean, you only buy a physical car once every 5 years. You pay for services every single month.
Right.
Whether that's healthcare, auto insurance, or, on the corporate side, cloud hosting and enterprise software maintenance. The capital bleed is constant.
And that constant bleed is jacking up the 10-year Treasury yield. We are seeing a spike of 12 basis points this morning, hitting 4.38% on significant pre-market volume.
What's fascinating here is how this inflation ghost is pulling the strings on the 10-year. Because for the active traders listening, when yields gap up like that, it sends immediate shockwaves through the mega-cap tech sector.
Yeah, I want to drill down into the mechanics there. Why does a global tech giant actually care if a government bond yields 4.2% versus 4.38%? It's the discounted cash flow models getting crushed.
It is the absolute mathematical foundation of how these companies are valued. If you are an institutional buyer projecting, say, NVDA or Apple's cash flows out to 2028 or 2030, you have to discount those future earnings back to today's dollars.
To figure out what the stock is worth this morning.
Exactly. And the foundational number for that discount rate is the risk-free rate, which is dictated by the 10-year Treasury yield.
Because that is the guaranteed return you could get by taking zero risk.
Correct.
Yeah.
So as that yield climbs, the opportunity cost of holding a volatile, risky stock goes up. I mean, you can get a guaranteed 4.38% from the U.S. government right now.
Wow.
So mathematically, the massive profits those tech companies might produce in 2030 instantly evaporate in present value terms. The equity risk premium, that extra return you get for taking on stock market risk, it just thins out to dangerous levels.
And we also have the dollar index, the DXY, catching a massive bid at a nominal 4.20 overnight due to European fiscal uncertainty.
Right, and a stronger dollar is the second half of that margin compression. The magnificent tech names are global behemoths, so they generate massive overseas revenues in foreign currencies.
So when they have to convert those euros or yen back into a wildly strong U.S. dollar, their actual reported earnings take a direct hit.
Exactly. So you have rising yields crushing their future valuations on the front end.
Yeah.
And a strong dollar eating their current operating margins on the back end.
Here's where it gets really interesting, though. If rising yields and a strong dollar are actively poisoning mega-cap tech, you might assume the AI boom is simply stalling out. But the pre-market movers tell a completely different story.
Yeah, they do.
The money isn't leaving the ecosystem. It is aggressively rotating into the hardened backbone of AI.
Just look at NVIDIA. The undisputed king of the hardware trade is down 1.4% pre-market. Our sources show reports circulating about a shift in the delivery timelines for their next-generation Blackwell chips.
Specifically for sovereign cloud providers, right?
Yes, which exposes a severe physical bottleneck. You can design the most efficient, powerful semiconductor architecture in existence, but if the global supply chain cannot physically deliver them at the scale governments are demanding, the entire sector is vulnerable to a pullback.
Right, it's not a demand problem. It's a physics and logistics problem.
Exactly. The fabrication plants in Taiwan, the advanced packaging facilities, they are maxed out.
But while NVIDIA takes a breather to figure out supply chain logistics, Palantir is up 4.2% this morning on heavy volume.
And this is not retail hype. They just secured a massive $800 million multi-year expansion with the Department of Defense to integrate autonomous fleets.
Let's actually look at how that integration works, because it proves AI is graduating from experimental pilot programs into hard budget line items.
Right.
When we talk about autonomous fleets for the DoD, we aren't just talking about a drone flying a pre-programmed GPS path.
No, we are talking about swarms of autonomous vehicles constantly communicating. They are analyzing threat data in real time and making split-second tactical decisions without human intervention.
And to run that kind of network, you need an absolutely bulletproof data architecture. The military isn't messing around with beta tests anymore. They are deploying hundreds of millions of dollars to build the operational nervous system for modern defense.
And that nervous system requires an elite immune system. CrowdStrike reported a massive beat on their annual recurring revenue last night. Their new Falcon 2026 AI Guardian module is seeing adoption rates 40% higher than forecasted.
Which makes sense. Just yesterday, a zero-day exploit hit legacy cloud nodes. It triggered a massive flight to safety.
But institutional capital didn't flee into cash. It fled into hardened infrastructure. Deep layer cybersecurity is no longer viewed as an IT expense that sits in a quarterly budget spreadsheet.
Right. If you are a Fortune 500 company, you cannot run a proprietary AI model on a vulnerable network. A single breach doesn't just steal your data. It poisons the training data your AI uses to make automated business decisions.
Exactly. So investors are dumping generic software as a service, the traditional SaaS names that just offer workflow tools, and they are pouring capital into the companies that protect the AI at the foundational level. They want the moat.
Which ties perfectly into JP Morgan CEO Jamie Dimon's overnight comments. He described the consumer as resilient but cautious.
And that anxiety is driving a barbell effect today.
Yeah, we see money flowing into defensive value, pushing JP Morgan itself up 0.8% pre-market, and money flowing into this hardened AI backbone.
That transition from the digital realm to the physical, secure realm is where the true next frontier of this market is exposing itself today. We mentioned the AI infrastructure bottleneck with NVIDIA's chips. But if security is the first prerequisite for the AI backbone, the physical world is revealing the second prerequisite.
Raw, uninterrupted energy.
Precisely. Let's talk about Constellation Energy, ticker CEJ. They are trading pre-market on highly credible rumors of a fresh 20-year power purchase agreement, or PPA.
With a Tier 1 data center provider, right?
Yes. And the objective is to literally revive a second decommissioned nuclear reactor.
Let's drill into the mechanics of a 20-year PPA for a data center. Why are tech giants willing to lock up billions in capital for 2 decades just for electricity?
Because the energy demands of these new AI training clusters are hitting a literal wall. The existing regional power grids cannot handle a Sutter 500-megawatt draw from a single facility.
It would just brown out the grid.
Exactly. So a PPA structurally changes Constellation's balance sheet because it guarantees fixed revenue for 20 years. That completely de-risks the massive capital expenditure required to restart a dormant nuclear plant.
And institutional capital is realizing that nuclear is the only clean, constant baseload power capable of feeding these AI facilities 247. Solar and wind simply don't have the uptime or the density.
Nope. So if Constellation breaks the $295 level on the open, the flow data suggests heavy institutional accumulation, targeting the psychological $310 mark. It's a literal power grab.
That is wild. And speaking of physical hardware integration, Apple is seeing unusually high pre-market volume due to a leaked supply chain report out of Asia.
The iBot.
Yeah, detailing an iBot home robotics pilot program.
The market is desperate for Apple to find its next revenue bridge beyond the iPhone 17. Robotics is the logical extension. You have the AI brain, you have the localized processing power on the silicon chips. Now you need the physical body to interact with the environment.
We spent the last few years building the AI brain, but now we are realizing that this brain needs a massive diet of nuclear power to stay awake, an immune system like CrowdStrike to stay healthy, and a robotic body like Apple's iBot to actually interact with our world.
Exactly. And if Apple finds acceptance above $215.50 today, it confirms a technical breakout. But a failure at 208.10 suggests the robotics hype might be premature.
But while we are looking at these massive multi-year macro shifts, we have to look at the immediate micromechanics of today's tape. Because right now, the market is sitting in a gamma flip zone.
Yes, it is.
I always hear traders throw this term around. This is when options dealers, the guys selling the contracts, actually have to buy the stock as it goes down and sell it as it goes up, just to hedge their own books, right?
That is the exact mechanism. When dealer gamma is negative, their hedging flows actively suppress volatility. They're forced to trade against the momentum, trapping the price in a tight box.
It creates that trapped, choppy feeling.
Right. The algorithms are just hunting for stop losses on both sides of the tape before the London close. Technically, we're looking at a classic symmetrical triangle setup on the charts. Lower highs on the short-term 15-minute chart, but higher lows on the longer 4-hour chart.
A coiled spring. Moving averages are converging, volatility is compressing, and we are just waiting for an algorithmic breakout trigger to fire. It is a textbook liquidity trap.
It really is.
So we need to give you the specific lines in the sand for today's session. For the S&P 500, that line is 6,145. That is the weekly volume point of control.
Meaning it's the specific price level where the highest concentration of actual trading volume has occurred this week.
Right. If we lose 6,145, the bears take control of the intraday trend.
And for the Nasdaq, the must-hold psychological line for tech bulls is 21,250. The absolute floor is 21,080. Buyers defended that level 3 times of overnight session.
Making it the final line of defense before we see a rapid 2% liquidation.
Exactly. The danger of a symmetrical triangle in a gamma flip zone is that it is designed to trap breakout buyers who jump in at the top expecting a rally, and fast money shorts who sell at the bottom expecting a crash.
So what does this all mean for the active trader who is just trying to navigate this chop? Because the temptation, especially when you see the Nasdaq dropping toward that 21,080 floor, is to play the old hits. You see tech drop, you think, great, buy the dip. It always comes back.
Acting on that reflex is the biggest blind spot in the market right now.
Yeah.
Retail traders are entirely missing what institutional desks refer to as the pain trade.
Okay, let me play devil's advocate here. If I'm an investor who sees this tech volatility and decides to hide out in boring, safe dividend stocks, utilities, consumer staples, the classic dividend aristocrats aren't insulated.
You'd think so, but no.
Because if the Nasdaq flushes, my utility stock paying a 3% dividend should be my bunker, right?
If we connect this to the bigger picture, that bunker is structurally compromised. We need to look at the terrifying mechanics of a long-duration flush. You are right that institutional desks have been using the recent tech volatility to hide in those exact bond proxies, the utilities and staples. The retail crowd thinks the pain is just a 2% drop in NVDA. But the real systemic pain is the hidden leverage in the carry trade.
Walk us through the math on that. How does a traditionally safe dividend stock trigger a systemic margin event?
It all rounds back to that 10-year Treasury yield we started with. Say a multi-billion-dollar fund is holding massive positions in safe dividend stocks yielding 3%. They bought those shares on margin, using borrowed money from their prime brokers.
Because historically, utilities are low-risk, low-volatility assets, the margin haircut requirements are minimal.
Exactly. But suddenly the 10-year yield spikes to 4.38%, and maybe the trend keeps pushing it toward 4.50%. The risk-free rate from the U.S. government is now paying 150 basis points more than the corporate dividend.
Right, so that 3% yield is now financially obsolete.
Precisely. Why would any rational actor take equity risk for 3% when you get a risk-free 4.5% from the Treasury? The broader market violently reprices those dividend stocks downward to make their yields competitive.
But remember, the institutions hold these on margin. When the underlying value of those safe stocks plummets, their collateral shrinks drastically.
And then the prime brokers pick up the phone.
A margin call.
A massive, forced liquidation margin call. And when a highly leveraged fund gets a margin call on their bond proxies, they do not get to choose what they sell. They have to sell whatever they can find immediate liquidity for to raise cash.
So they sell their winners, they sell their losers.
They sell their tech, they sell their value.
Everything goes out the window. It triggers a correlation to one event.
In a true long-duration flush, the concept of diversification completely fails. Everything gets sold at once to cover the leverage on the bond side. The pain trade isn't that tech money rotates into value. The pain trade is that if the 10-year yield doesn't find a ceiling, there is literally no sector safe from the forced selling.
Man, that completely shatters the illusion of a calm pre-market tape. To pull all of these threads together for you listening, today's flat indices are a mirage. Do not be fooled by the S&P parked at 5,910.
We are witnessing a ferocious underlying rotation out of generic tech software and into the physical and security backbone of AI.
Yeah, we are talking deep layer cybersecurity like CrowdStrike and literal nuclear power generation like Constellation Energy.
And while that rotation happens underneath, the 10-year Treasury yield is threatening to trigger a margin cascade that could upend the traditionally safe dividend sectors of the market.
So, actionable advice for today's session. Our flow data classifies today as a strict no man's land for swing traders. The market is setting a liquidity trap. Keep your position sizes small and protect your capital.
Right.
If you are looking for a gap and go, you probably won't find it until the macro data settles on Friday.
Your ultimate compass today is the VIX, the volatility index. If the VIX stays sub 15, those breakout levels in the infrastructure names have a high probability of holding.
But if the VIX spikes, abandon the long setups.
Exactly. That's when those bear entry zones, like a break below 21,080 on the Nasdaq, become highly actionable.
Keep your stops tight out there. And as we leave you to watch the opening bell, I want you to think about a larger implication of what we discussed today.
Yeah, this is important.
We've spent decades celebrating the software engineers, the agile startups who built the digital world in the cloud. But if the most valuable technology companies on Earth are now relying on massive 20-year contracts for literal nuclear reactors and taking control of the physical power grid just to run their AI models,
It begs a totally new question.
it does. How long until Washington stops regulating these tech giants like agile software startups and starts regulating them like national utilities?
When you own the grid, you own the infrastructure of the country. It changes the legal and regulatory definition of a tech company entirely.
It completely redefines what a tech monopoly looks like. Keep an eye on the 10-year, watch those key volume nodes, and we will catch you on the next deep dive.